Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, April 19th at 11:30 a.m. in New York. So let's get after it. Over the past few weeks, the economic data has been nothing short of remarkable. While impressive, it's not really that much of a surprise, though, at least relative to expectations. And ultimately, that's what matters for investors. Furthermore, many data series are likely peaking from a rate of change standpoint. In fact, the rally in bonds over the past few weeks has surprised many, but the reality is that these strong data were already well understood by markets. We've discussed this point in our research over the past few weeks, and in our view, we're moving from early to mid-cycle in this recovery. In fact, this transition is happening about twice as fast as we've experienced in prior recessions and recoveries. This also fits well with our view that this cycle will be different, most notably that it will run hotter, but also shorter. As such, there are implications for equity portfolio managers to consider. In particular, we note our call to upgrade one's portfolio by moving up the quality curve 3 weeks ago. Indeed, high quality has started to outperform low quality, and we think this is going to continue. It also shouldn't go unnoticed that most of these cyclical, speculative, and lower quality indices on a global basis have also been underperforming now for months. While the high-quality S&P 500 and NASDAQ 100 are making all-time highs, many other indices have peaked and failed to recover. Meanwhile, many commodities are also laboring as high-quality S&P 500 and NASDAQ 100 breakouts look more and more isolated every day. Finally, the breadth of participation has deteriorated significantly, whether we're talking about the very broad Russell 3000 index or the tech-heavy NASDAQ composite. What this really means to us is that the market gets it, and is preparing for what is likely to be a more difficult environment for stocks and risk assets generally. As we've been discussing for weeks, we think there are several concerns fast approaching that will become more obvious during this earnings season. More specifically, rising cost pressures, supply shortages, the peak rate of change on earnings revisions, and retail demand for stocks being overwhelmed by supply. On this last point, we've been watching how poorly new equity offerings have been trading recently, which in our experience is an early warning sign on real-time liquidity dynamics. Now that earnings season has begun in earnest, we have some real-time examples on how stocks are trading on the back of what should be very strong results. Last week was mostly about large-cap bank stocks, and while this is a sector we like and continue to recommend, many of these stocks sold off on what were terrific first-quarter results, much like bonds rallying on strong economic data. In short, the market has already priced these strong results and is likely to pull back as these facts are revealed. While we are less bullish on the more speculative and cyclical parts of the market in the near term, we retain high conviction in our reflationary view over the next 12 months. Hence, we remain overweight financials, materials, and industrials. Meanwhile, we remain neutral on technology and overweight healthcare, given the greater valuation headwinds on the former. Perhaps the best way to characterize our view is that we like reflation beneficiaries but no longer favor the reopening theme so much, given the excessive valuation that discounts much of the recovery for many of these stocks and the execution and margin risk as the reopening actually happens. Bottom line, many individual stocks and narrower indices have been correcting for months. This is very normal as the economy moves from the early stages of a recovery to mid-cycle. Therefore, we continue to recommend a bit more defensiveness in one's positioning and patience with new investment purchases. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.